In this presentation, we'll explore how to move systematically from the big picture down to specific trades. Our journey follows three essential pillars: developing a global perspective to see cross-border connections, applying systematic analysis to identify structural shifts, and executing strategically with risk-aware positioning. Whether you're new to macro investing or refining your process, this framework will help you see markets not as isolated assets, but as parts of a dynamic, interconnected system. Top-down investing follows a five-step analytical cascade. We begin at the highest level with the global macroeconomic environment, examining growth trends, inflation dynamics, and monetary policy. Next, we drill down to regional and country analysis, identifying which economies are positioned favorably. From there, we assess sector and industry dynamics within those regions. This informs our asset class selection, deciding between equities, bonds, commodities, or currencies. Finally, we select specific instruments that express our macro view. As the slide notes, by grasping the big picture, you'll clearly see details that bottom-up analysis alone might miss, because context transforms observation into insight. Let's compare top-down and bottom-up approaches side by side. Top-down analysis starts with the global economy, monetary policy, and geopolitical trends. Its focus is on macro themes, regime shifts, and cross-asset relationships. Its strengths: identifying structural opportunities and managing systemic risk across your portfolio. Bottom-up analysis begins with individual companies or securities, focusing on fundamentals, valuation, and competitive advantages. Its strength lies in finding mispriced securities through deep company knowledge. The critical insight here is essential. Modern global macro requires integrating both approaches. Avoid dogmatic adherence to one method. Blend top-down context with bottom-up insights for superior decision-making. This framework transforms macro views into actionable positions through four sequential stages. Stage 1. Regime recognition. Identifying the dominant market environment using indicators like business cycle phase, monetary policy stance, and risk-on/risk-off conditions. Stage 2. Theme identification. Spotting structural shifts with multi-year durability, such as demographic changes or technological disruption. Stage 3. Chain reaction analysis. Mapping ripple effects through second and third-order consequences. For example, central bank tightening might strengthen the dollar, trigger emerging market capital outflows, and create commodity pressure. Stage 4. Position construction. Building optimal instruments with proper sizing and asymmetry to express your view. Each stage builds on the previous one, creating a disciplined investment pipeline. Effective regime recognition relies on monitoring key indicators across four categories. Capital flows, tracked through TIC data, and EPFR fund flows, reveal cross-border money movement. Market positioning, using CFTC commitment of traders reports, helps identify crowded trades primed for reversal. Policy signals, from central bank statements and forward guidance, anticipate monetary shifts. And risk sentiment, measured by VIX term structure and high-yield spreads, determines whether we're in risk-on or risk-off mode. The cross-asset framework then shows how these regimes impact different markets. In risk-on environments, equities and commodities typically rally. During risk-off periods, bonds and the US dollar strengthen. Understanding these relationships before trends emerge is an invaluable weapon in a global macro investor's arsenal. Once you've identified a powerful theme, follow this three-step implementation process. First, identify the theme itself, ensuring it has multi-year durability, clear transmission mechanisms to markets, and policy tailwinds. Second, follow the chain of events. Map primary beneficiaries and casualties, then anticipate second and third-order effects across asset classes. Third, identify optimal investments. Evaluate relative value opportunities while considering liquidity and implementation costs, always structuring for maximum asymmetry. The table shows practical examples. For deglobalization, you might use country-specific emerging market ETFs while going long domestic manufacturing versus global exporters. Remember the wisdom on this slide. Keep it simple. Most powerful trends are obvious. Invest in them with discipline. Risk management separates successful macro investors from the rest. Position sizing follows this formula. Optimal size equals conviction times expected return, divided by volatility times correlation to your existing portfolio. A practical rule: base size on volatility, risking 1% of your portfolio per 10% asset volatility, then adjust for correlation. Always define your maximum loss before entry. The Netto Number evaluates performance quality, annualized return divided by maximum drawdown. A ratio of 1 to 1.5 is acceptable. 2 or higher is excellent. Finally, allocate risk appropriately to market regimes. In trending markets, use higher risk budgets with moderate concentration. In range-bound markets, lower risk with higher diversification. And during transitions or crises, minimize risk exposure until clarity emerges. Macro investing thrives on daily discipline. Start each session with 3 steps. Scan global price action and overnight data releases. Review your current positioning and risk levels. Then prepare for the day ahead by identifying key catalysts and setting contingency plans. Anchor your decisions with 4 questions. What is today's dominant macro narrative? How does my positioning align with fundamentals? Where are markets mispricing reality? And most importantly, what evidence would make me change my view? Remember this critical distinction. Are you positioned for the most probable outcome or the most profitable one? Not every market move demands a macro explanation. But when genuine macro moments emerge, like a semiconductor shortage triggering equipment maker rallies, then auto production cuts, then soaring used car prices, follow the chain reaction to its final link. Anticipate second and third order effects. Coordinate with where markets are actually pricing risk. True alpha comes from differing from consensus at the right moment, with conviction grounded in rigorous analysis. Looking ahead, 4 capabilities define tomorrow's macro practitioners. Synthesis capability, connecting disparate data into coherent narratives. Regime agility, adapting swiftly as environments shift. Positioning awareness, understanding portfolio interactions with current regimes. And asymmetric construction, structuring trades where upside meaningfully outweighs downside. Top-down trading has evolved across eras. The 1970s and 80s relied on intuition, limited by slow data flow. The 2000s introduced hybrid discretionary systematic approaches with early quant tools and Bloomberg terminals, yet analysis remained siloed. Today's integrated multi-factor frameworks leverage machine learning, alternative data, and real-time analytics, though challenges like information overload and crowded signals persist. The horizon points to AI-augmented discretion, causal inference models, and natural language processing, parsing central bank communications, always wrestling the timeless challenge of signal versus noise. This flowchart is the complete global macro workflow, a continuous, cyclical process. It begins with information gathering, monitoring macro data, central bank communications, and geopolitical developments. Next, regime recognition, identifying risk-on or risk-off conditions, business cycle phase, and cross-asset correlations. Then, theme identification and chain reaction analysis, spotting structural shifts and tracing primary, secondary, and tertiary market impacts, followed by position construction, selecting assets, determining sizing, and structuring for asymmetry. Then execution and monitoring, tracking real-time price action, updating positions, and adapting strategy as themes evolve. Critically, risk management runs continuously throughout, applying stop losses, drawdown controls, and value at risk parameters. Finally, performance assessment, reviewing the Netto Number, conducting regime attribution, and refining the process for continuous improvement. This cycle, gathering, analyzing, acting, managing, learning, transforms macro insight into disciplined action. Internalize this workflow, and you equip yourself to navigate global markets with clarity, consistency, and confidence.